Hi friends, good morning. ICAI has came out with a revised study material applicable from May 21 exam onwards. We were discussing the changes which are there in FR. Yeah, the updates. Again, I just tell you, whatever we have learnt in our lectures remains as it is. These are few additional questions and few additional concepts. Now, we've done all the chapters other than consolidated financial statement. So let us see the updates which are there in the chapter of consolidated financial statements. Chapter number 14, CFS. The sheet you are already having, please make sure you have a printout of the sheet and you mark down the things which we are doing. Now we have some extra questions added. These are related to exemption from preparing CFS. Okay, tell me, who is exempted for preparing CFS? Sir, intermediate subsidiary. What is intermediate subsidiary? You are a subsidiary of someone, but you are also a parent of someone. Intermediate subsidiary. Provided intermediate subsidiary is unlisted, it's not listed, not in process of listing. The ultimate parent. The ultimate parent has to be preparing financial statements as per Ind AS. The ultimate parent is preparing financials as per Ind AS which are available. Then the intermediate subsidiary is exempted. Okay, so we have a question on this. Company X, they hold 100% in company A, and company A holds 100% in B and C. Now X is a listed company. Okay, the ultimate parent is a listed company, and they prepare financial statement as per Ind AS. Okay, the ultimate parent prepares as per Ind AS. This intermediate subsidiary, company A, they are exempted provided they are unlisted, they are not in process of listing. Now here company A is wholly owned by X. Company A is wholly owned by company X. If it was partly owned, the other shareholders of company A does not object for not preparing CFS. So that is there, and the ultimate parent is preparing as per the Ind AS. So let's see. So X is listed entity that they already given. They prepare financials as per Ind AS. Company A is unlisted, not in process of listing, and company X does not object for company A not preparing CFS. So actually all conditions are satisfied. So company A will be exempted from preparing CFS. Okay, scenario B. Now same fact as per scenario A, except company X is a foreign entity. Okay, if company X is a foreign entity, they don't prepare financial statement as per Ind AS. Okay, then the ultimate parent is not preparing as per Ind AS, exemption will not be available. So scenario A, exemption available. Scenario B, exemption not available. Scenario C, same fact as A, except 100% of investment in company A is held by Mr. X instead of company X. So imagine it's not company X, it's Mr. X, individual. Now individuals are not required to prepare financial statement as per Ind AS. Yes, individuals are not required to follow Ind AS. So again, company X is there, ऊपर Mr. A है. Mr. A doesn't prepare as per Ind AS, so again exemption will not be available. So sir, when is the exemption available? One, you are unlisted. Second, your other shareholders don't object that you're not preparing CFS. And third, आपके ऊपर someone, आपके ऊपर the parent, ultimate parent or intermediary parent, they are preparing financial statement as per Ind AS. So they are preparing CFS as per Ind AS. First case, all things satisfied, they are exempted. Second scenario, parent is a foreign entity, they will not be preparing financials as per Ind AS. Third case, आपका parent is individual, They don't prepare as per Ind AS, again exemption will not be available. Okay, the first case, you are not required to prepare CFS. Second case, you cannot avail the exemption. And third case also, you cannot avail the exemption. So scenario A, exemption available. B and C, not available. Okay, going to the next question. Question 2. Following is the structure of a group headed by company A. Okay, company A holds 100% in B. They hold 60% in C, and C holds 100% in X. Okay, so if I ask you, which is an intermediate subsidiary? Intermediate subsidiary. You are a subsidiary of someone and parent of someone. So C. Yes, C is an intermediate subsidiary. So C can have an exemption provided company C is unlisted, not in process of listing. Shareholders of company C. Shareholders of company C is company A and other 40%. 60% is company A, others are 40%. They do not object for company C not preparing CFS. And third, the ultimate parent, company A, should be preparing CFS as per Ind AS. Okay. So A is listed in India, main parent. A is listed in India, they follow Ind AS. C is unlisted. C is unlisted. Company A and balance 40% held by outside investors. Company A does not object. Now company A does not object for C not preparing CFS. Others also should not object. Okay, the C is unlisted. Fine. Ultimate parent prepares as per Ind AS. Fine. Now, in C, 60% held by A, 40% by others. They all should not have a problem. They should agree that company is not preparing CFS. Okay, company A does not object. Whether company C is required to prepare CFS, whether company C is required to prepare CFS, assuming those who hold remaining 40%, they also don't object. Assuming those who hold 40%, they also don't object, then they are exempted. Okay, scenario B. Assume the same fact as scenario A, except 40% balance is held by company C. Okay, of company C is held by B. Okay, same fact, but assuming remaining 40% is held by B. Okay, remaining 40% is held by B. B is under 100% control of A. So indirectly, C is under 100% control of A. So in C, 40% B holds, 60% A holds. And so 40% suppose B holds, 60% is A holding, and A holds 100% in B. So indirectly, A holds 60% directly, 40% through a wholly owned subsidiary. So A holds 60% directly, 40% through a wholly owned subsidiary. Fully C is also held by A. In that case, A holds 100% in C. If A agrees that okay, C doesn't prepare CFS, it's fine, it's okay. You don't have to ask anyone else. But first scenario, 40% is with others, unka approval is required. Okay, if I just go to question, they're asking, state whether C is required to inform other shareholders, that is B Limited, which are owning 40% of intention not to prepare CFS. See, you don't have to tell. You don't have to tell reason. B is ultimately controlled by A and A has already agreed. B holds my 40%, but B is ultimately controlled by A. A has already agreed that if I don't prepare CFS, it's fine. So यहाँ पे I don't have to ask to B also, because B is wholly owned by A, whose approval I already have. Okay, so first scenario, they are telling C should inform the other 40% about C not preparing CFS. And if they do not object, then you can avail the exemption. So you have to inform to other 40%. Other 40% is held by others. 60% by A, 40% by others. A has given approval. Others का भी approval लेना पड़ेगा. Second case, 40% is held by B and B is 100% controlled by A. So B is 100% held by A. A's approval I have. I don't have to ask anybody else. Okay, so C is 100% held by A, 60% direct, 40% through B. C is not required to inform company B and can avail the exemption. You don't have to inform company B as, I just add over here, as 100% of company B is held by company A, whose approval is already there. So I don't have to ask B because 100% of B is held by A, whose approval I already have. This is about exemption. Just few questions added, few simple concepts added. We are covering that. Okay, next question number 3. Okay, asset manager has set up an investment fund. Okay, asset manager has set up an investment fund for the purpose of acquiring capital contribution from various investors. The various investors give money to investment fund. Investment fund will invest in equity shares. The investors give money to investment fund will invest. So normally you will feel investment fund is an investment entity. You get money from various investors for the purpose of earning capital appreciation or dividend income as required by investor. So this investment fund as such looks like a investment entity. And our investment entity is again exempted from preparing CFS. Investment entity is again exempted from preparing CFS if they measure their investments at fair value through P&L. So they have to measure the subsidiaries at FVT P&L. Now, the various investors invest the money in investment fund. Investment fund will then invest. Now, investment fund also gives advisory services, financial support. Giving advisory services, financial support is not the work of investment entity. If that is the case, then it will not be an investment entity. I need to see substance. I need to see the substance. Advisory and financial support is what? If it's very minimum, I can still count it as investment entity. But advisory support, advisory services, financial support, if it is huge, then you are not investment entity. Okay, let's see. Apart from investment in various entities, the investment fund also provides its investee advisory services, which can result in increase in capital appreciation. It also provides investees loan We give loans also. Now that is not the work of investment entity. The investment fund does not hold investment for a period longer than 5 years, and they measure the performance on fair value basis. Whether investment fund can be treated as investment entity. You acquire money from public, you do investment for the purpose of earning capital appreciation, dividend as promised to investors. You measure your investments at fair value, that all criteria satisfied. But you're also giving loans, giving advisory. This is actually not the work of investment entity. Okay, let me do one thing. I go to the definition of investment entity. You done in class? I just go to the definition of investment entity. I just zoom it so that it's visible. Okay, investment entity. We have 3 points ABC. Here, as per Ind AS 110, investment entity is an entity that obtains funds from investor for providing investment management services to those investor. They obtain funds for providing investment management services. Whose business purpose is to invest funds solely for the return in form of capital appreciation, investment income, or both as committed to investor. And you measure the performance of substantially all your investment at fair value. Okay, so you obtain fund from various people. Your purpose is to invest solely for return in form of capital appreciation, investment income as committed to the investor. And you measure your performance on fair value basis. Now, investment entities don't give loans. So that's the problem. Let's see. Okay. Now, with respect to objective of investment fund, the objective is to earn capital appreciation. Strategic advisory services, financial support provided are extended with the intention to earn higher appreciation from investees. Now, judgment should be applied that this do not represent substantial business activity or a substantial separate source of income. Judgment should be applied. There's no clear-cut answer. If that loan wala portion, advisory wala portion is not major, then we still say it's an investment entity. But if loan wala portion, advisory wala portion is major, then it's not a investment entity. I hope you're clear. If investment fund concludes that these services, financial supports are not substantial, very clearly written, if they conclude that these are not substantial, then only they are treated as an investment entity. If you conclude that advisory service, financial support to investee, they are not substantial business activity, then you are investment entity. Okay. Next, they are telling investment entity should have exit strategy. Some bit theory are added. Investment entity should have a exit strategy. They cannot plan to hold investment lifetime. They need to have a exit strategy. Different strategy is possible for different types of investment. Different strategy is possible for different types of investment, but they need exit strategy. Okay? Question 4 is fine, you can study on your own. Question 4 is fine, you can study on your own. Next, now investment entity should be earning incomes in form of capital appreciations, investment income. They should not be for other motto. They should not be for other motto. So check. To be an investment entity, you have to be committed to its investor that the business purpose is to invest solely for capital appreciation, investment income, or both, nothing else. Our purpose is to earn capital appreciation, investment income, that's it. There is one company which has a patent and we are interested in that patent and that's why we invest. Then that's not investment entity, because purpose is to get patent. That's not allowed. An entity is not investment entity if the entity or group member containing entity has objective of obtaining other benefits from the entity's investment that are not related to unrelated parties. Okay, pay attention. Pay attention. Investor has given money to me. I invest in an entity. Because of that, investor gave money to me. I invest in an entity. Because of that, that entity's patent goes to my investor. That entity's patent usage goes to my investor. I am not an investment entity. Why I am not an investment entity? Purpose is not solely to earn capital appreciations or investment income. Purpose is also to derive benefit out of the patent. So my investor can derive benefit out of the patent. That is not allowed. So to be an investment entity, entity must commit to its investor that its business purpose is to invest funds solely for return from capital appreciation, investment income, or both. You are not an investment entity if you or any of your group members containing where the entity falls has the objective of obtaining other benefits from the entity where you are investing. So that should not be there. Let's see the question. Let us see the question. I just mark it as important. Question 1 important. Question 5 important. 1 which we did important. 5 is important. Okay, PQR is established with a primary objective of investing in equity shares of various pharmaceutical companies. Okay, primary objective, invest in pharma companies which are involved in research of medicine for a critical illness. Okay. DF is a fellow subsidiary of PQR. Okay, if I just go over here, there's a PQR, DF, they are fellow subsidiaries. Means they will have a same parent. They will have a same parent. They are fellow subsidiaries. Okay, PQR does investment in pharma. PQR does investment in pharma. And DF has entered into contractual arrangement with all investees of PQR. Okay, the PQR does investment in some research company. The fellow subsidiary of PQR has done a contractual arrangement with all of them. PQR has invested in equity shares of pharma companies which are doing research, and fellow subsidiaries of PQR has entered into a contractual arrangement to use their research. Now pay attention. So either me or my group entity, are they getting other benefits? Yes. I'm not getting, but my group entity, fellow subsidiary, they are getting other benefits. So PQR is not investment entity. So whether PQR can be classified as investment entity, answer will be no. Whether PQR can be classified as investment entity, no. My group member is getting other benefits from my investment. The sole purpose is not to get capital appreciation. My group members are getting other benefits. Okay, this is done. Next point. Okay, accounting for change in investment entity status. Okay, you were not a investment entity, now you become investment entity, or you were a investment entity, now you cease to be a investment entity. Earlier your group members were not getting other benefits, now your group members started getting other benefits. So accounting for change in status of investment entity, you should account for such change prospectively. Now onwards, prospectively. Okay, so accounting when entity ceases to be investment entity. Earlier you were investment entity, now you are not. Okay. Earlier you were investment entity, you got exemption from consolidation. Earlier you were investment entity, you got exemption from consolidation, but you will be showing your investments at fair value. Now you cease to be investment entity, start consolidating. Start consolidating. Earlier you were not consolidating, now consolidate. Now, so this is called date of change is said to be deemed acquisition date. The date of change in status shall be deemed acquisition date. Now you start consolidating. All subsidiaries shall now be consolidated. Start consolidating. Just write over here, start consolidating now. So earlier you were investment entity, you were exempted from preparing CFS, you were exempted from basically consolidating your investments even though you hold more than 50%. Now you start consolidating. And value of investments which is there in your books, value of investment, you are showing them at fair value na? Every time you are fair valuing it, value of investment in your books today becomes the deemed consideration which you paid. Okay, the fair value of subsidiary at deemed acquisition date shall represent the deemed consideration. Okay, so whatever value appears today, what is the fair value today? That becomes the amount which you have paid to acquire that subsidiary. Find goodwill based on that. Okay, so earlier you were investment entity, you were exempted from preparing CFS. Now you cease to be investment entity, you have to prepare CFS. You have to prepare CFS. Okay, from today, now onwards. So whatever is the fair value of your investment today, that becomes your deemed consideration. Check question. A Limited ceases to be investment entity from 1st April 01. Okay, you cease to be investment entity from 1st April 01 and you're holding 80% of B. Carrying amount of investment. Carrying amount of investment which is measured at FVT P&L. Okay, carrying amount of investment in B which is measured using FVT P&L is 4 lakh. Okay, so 4 lakh is the fair value of such investment today. So 4 lakh becomes your consideration. Fair value of NCI is 1 lakh. Okay, so my consideration 4 lakh. NCI is 1 lakh. Compare with the fair value of identifiable assets and liabilities today. So 4 lakh, NCI is 1 lakh, identifiable net asset is 450. Okay, for 80%, my consideration 4 lakh, NCI 20% is 1 lakh, total 5. We are getting a net asset of 450. We paid extra 50 goodwill. 50,000 will be coming as goodwill. Goodwill 50,000. हो गया. So just try to understand the theory. If someone is able to understand the theory properly, automatically things will be fine. So earlier you were investment entity, you were not consolidating. Now you are not an investment entity. Start consolidating. Whatever is fair value of investment today becomes your deemed consideration. तो 80% के लिए 4 lakh, remaining NCI का fair value given is 1 lakh, total 5 lakh. Net assets will come 450, extra 50 will show as goodwill. Next, when you become an investment entity, when you become an investment entity, the earlier you were not investment entity, you were consolidating. Earlier you were preparing CFS, now not required. Or you were consolidating, now that's not required. When you become investment entity, तो क्या करे? So you cease to consolidate the subsidiaries at the date of change in status. You cease to consolidate the subsidiaries at the date of change in status, except for subsidiaries which also give services like investment entity. That's not your investment over there. That is a real subsidiary which gives services related to investment entity. Okay, so we have done this concept. When we did topic of investment entity. Even though you are investment entity, few entities, few subsidiaries, they are not just pure investment, they are real subsidiaries which are basically, they are not for the end purpose of just investment, they are doing activities related to investment entity, they are still to be consolidated. Okay, now if you become investment entity, that subsidiaries will still be consolidated. Other subsidiaries which were just investments, they will not be consolidated. Now earlier they were consolidated, now they are not to be consolidated. It's like loss of control. Subsidiary sold. Okay, so what should I do? You are required to apply the requirement of loss of control, like subsidiary sold. So whenever subsidiary is sold off, assets and liabilities related to them goes away, goodwill capital reserve goes away, NCI goes away. तो assets and liabilities जो add किए थे goes away, NCI goes away, goodwill capital reserve recorded goes away. Investment will come in at fair value. Okay, investment will come in at fair value. Okay, the CD purchase 100% for 20 lakh on 31st March 1 when fair value of net asset is 16 lakh. Net asset 16, I paid 20, 4 lakh was goodwill. 4 lakh was goodwill. Now you become investment entity. If it is investment entity, fair value is 25 lakh. Ab books में earlier not a investment entity, assets liabilities there, goodwill there, NCI nil. we hold 100%. We hold 100%, NCI nil. So carrying amount of net asset excluding goodwill is 19 lakh. Okay, the net assets 19 goes away, goodwill 4 lakh goes away. The net asset 19 excluding goodwill, goodwill 4, total 23 goes away, and investment will come in at 25 lakh, the fair value. 23 goes, 25 comes, 2 lakh is gain. Okay, the gain on disposal. This is investment comes in, and net asset goes out. Net asset goes out, NCI is nil. The net asset, goodwill, capital reserve, NCI, they all go out. Now we don't have to consolidate. The net asset jo tha, goodwill jo tha, NCI was nil, that all goes out. Investment comes in, 23 asset goes, 25 comes in, net 2 lakh rupee gain. I hope you're clear. I hope you are clear. These are a few additional questions which are added. I'm just taking it. Okay, next point, joint operation, joint venture. Whether it's a joint operation, whether it's a joint venture, if new entity created, okay, joint control hai, but a new entity created, it's a joint venture. New entity not created, generally it's joint operation. You can read it, it's fine. Question 8 is for your self-study. Question 8 is for your self-study. Next, upstream downstream transaction between entity and its associate or joint venture. Okay, it's not entity and subsidiary, it's associate joint venture के साथ. तो upstream downstream. Okay, so imagine this is entity, we have associate or JV. Entity selling to associate or JV is downstream. Entity selling to associate JV is downstream. Associate JV selling to the entity, that's upstream. That's written. What is upstream? What is upstream? Sale of asset from associate joint venture to the investor. Associate joint venture selling to investor is upstream, and investor selling to associate joint venture is downstream. So upstream, downstream. Now whenever there is upstream downstream transaction between entity and its associate or joint venture, there will be some gain loss. So entity sold to associate, yeah, associate sold to entity, there will be some gain loss. How to record? Let's see. The entity shall record such gain loss in financial statement only to the extent of unrelated investors' interest in associate or joint venture. So we should record profit or loss only to the extent of unrelated investors' interest in associate or joint venture. Sir, ये क्या है? What is this? Imagine, pay attention, pay attention. Say we have A limited, there is B limited, B is an associate. B is an associate. Now A sold goods to B. Imagine A sold goods to B. Now in B, 30% is my share. A sold goods to B. B में 30% is my share only. I should record profit only equal to 70%. 30% तो वहाँ पे मैं ही हूँ. So whatever 30% is my profit on my share only. So even if goods are with B, A sold to B, goods are lying with B. If B has sold to someone else, A sold to B, B sold to someone else, then nothing is unrealized. You can record full profit. A sold to B, B sold to others, you can record full profit. But A sold to B, goods are lying with B. A sold to B, goods are lying with B. 30% in B is me only. So I should not record full profit. वहाँ पे 30% तो मैं ही हूँ. 70% is others. That much I can record. The entity shall record gain loss to the extent of unrelated investors' interest. Unrelated investors' interest. That is other investors या other joint venturer का share. उतना आप record करो. So out of what I sold, 30% is me only over there. 70% is kind of to outsider. Okay, let's see the question. Ninth, important. M has invested in 40% share capital of N. M has invested 40% share capital of N. N is an associate of M. During the year, N sold inventory to M, associate to investor. It's upstream. Upstream. So associate to investor. And associate made a profit 1 lakh. Okay, they sold for 10 lakh, profit is 1 lakh. Okay, so associate earned a profit. Associate earned a profit 1 lakh. Now out of the inventory, M sold 6 lakh to outsider. ठीक है, you sold me of 10, 10 में से 6 are sold to others. 10 में से 6 are sold to others. Out of above, inventory of 4 lakh is still lying with M. Okay, inventory of 4 lakh is still lying with M. Okay, first of all, associate has sold to investor. Associate earned a profit 1 lakh. That is fine. Standalone, they are separate entities. So N has earned a profit 1 lakh. Now M holds 40% of N. So 1 lakh का 40%. 1 lakh का 40%. 40,000 profit comes to me equity method में. Okay, so now as part of equity method, M will pass the entry. This is for share of profit. This is 1 lakh into 40%. This is share of profit. The share of profit coming is 40,000. Now, share of profit coming is 40,000. Pay attention. ठीक है. Now, what is the entry for share of profit? I did not got cash. I added to my investment. I did not got cash. I added to my investment. Investment in N limited debit to share of profit from N. Okay, so share of profit comes. N earned 1 lakh. Usme se 40,000 comes to you. Now that 1 lakh was on goods of 10 lakh. 1 lakh was on goods of 10 lakh. Usme se 4 lakh ke goods are still with me only. Okay, the 40% goods are still lying with you. The 40% profit. Okay, you recorded this much your share of profit, but a 40% goods आप ही के पास है. 40% profit is said to be unrealized. 40,000 into 40%, 16,000 is unrealized profit. Okay, 16,000 is unrealized profit. So however, inventory worth 4 lakh is still held by M. उसके अंदर total profit is 40,000. M का share 40%, 16,000. 10 lakh पे 1 lakh profit, तो in 4 lakh there was 40,000 profit. 40 में मेरा share, 40 में मेरा share is 40%, 16,000. This is unrealized. You have to record relating to other share. आपका नहीं. तो goods lying with me. Goods lying with me. I got a profit. वो कैसे हो सकता है? ठीक है. N sold to you. N earned profit 1 lakh. You hold 40% in N. 40% profit came to you. 40% profit came to you. 40% profit. 40,000. 40,000 profit came to you for 10 lakh of goods sold. Now 4 lakh of goods are still with you only. तो उसका profit is unrealized. तो your share 40,000 total. उसमें some goods are with you only. That much profit is unrealized. So we remove from profit, we remove from inventory. Okay, so to reverse unrealized profit, remove from P&L, remove from inventory. Goods are with us. N has sold to us. Goods are with us. That's why we remove from inventory. Now same question, same facts as scenario A, but inventory is sold by M to N. Okay, it's M to N. It is now downstream. Investor to associate. Okay, we sold. We sold. So first when we sold, we have recorded sales 10 lakh, we have recorded profit 1 lakh. When we sold, we have recorded profit of 1 lakh. ठीक है? Now we sold, they have sold 6 lakh to others, 4 lakh is still with them. 4 lakh का 10%, our margin 40,000, उसमें हमारा share is unrealized. 40,000 का 40%, 16 is unrealized. Okay, so if this all is for CFS, separate financial में if N sold, N has recorded full profit. If M sold, M has recorded full profit. This is only for CFS. Okay, out of inventory we sold 10 lakh. They have sold 6 lakh to outsiders. 4 lakh is still with them. 4 lakh is still with them. Okay, 4 lakh was still with them. Now on that 4 lakh we had earned 40,000. Now 40% over there is me. That 40% is unrealized. 40% is unrealized. Now pay attention. 40% of 40,000, 16,000 is unrealized. Now we sold inventory to N. Inventory is with associate. Associate के assets and liabilities don't come in CFS. Associates assets and liabilities don't come in CFS. I can't write to inventory. I can't write to inventory. Associate का assets liabilities don't come in CFS. So if goods are with us, I could have written to inventory. So as goods are with us, हमारे पास है, we can remove it from inventory. But this is your point A, solution scenario A. Goods are with us. But if we sold to associate, we sold to associate. Goods are now with associate. If goods are with associate, unke goods don't come in CFS. In CFS, investment in associate appears as investment in associate. Unka post acquisition profit comes, equity method. Unke assets and liabilities don't come. They can't write to inventory. We deduct from investment. That's why investment as goods are with associate, that is N limited. I just write associates assets and liabilities don't come in CFS. So how do I eliminate? Okay, I sold goods, I earned profit of 1 lakh. I sold goods, I earned a profit 1 lakh. Now 40% goods are, मतलब 4 lakh के goods are still lying over there. वो 4 lakh के goods में profit 40,000, उसमें my share 40%. तो I earned a profit total 1 lakh, I sold to them. वहाँ पे 4 lakh goods are lying. In that my profit is 40. उसमें मेरा share. उसमें मेरा share because वो associate में my share is only 40%. तो 40,000's 40%, 16 is unrealized. And I don't have inventory, so I can't remove inventory. It will be investment. And sales gone 160, COGS gone 144. Net is sales gone, COGS gone. Net is 16,000. When I have sold, I remove sales also, COGS also, so that GP margin is set. When I have sold. When they have sold, I can't remove sales. When I have sold, I remove sales and COGS, both. Net 16 I am removing. As we sold, we remove proportionate sales and COGS. If we are selling, we remove sales also, COGS also. Net we are removing 16 profit. If they have sold to us, I can't remove sales. I directly remove from P&L. P&L to inventory. Okay. Hope this is clear. So, if goods are unsold with associate or with us, उसमें जो हमारा ही शेयर था, our share, that is unrealized. सिर्फ our share is unrealized. Okay, now these 2 points are important. These 2 points are important. Logical. Very logical. When downstream transaction provides evidence of reduction in NRV of the asset sold, it provides evidence of reduction in NRV, then that loss should be recognized in full by investor. Downstream transaction. Okay. You sold to associate at a loss. You sold to associate at a loss. Don't say, sir, वहाँ पे goods पड़े हैं तो my share of loss is unrealized loss. If value has really gone down, 10 lakh का cost का inventory, cost 10 lakh, you sold for 8 lakh, 2 lakh loss. Now don't say, sir, goods मेरे पास ही पड़े, वहाँ पे my share of loss is unrealized. If value has really gone down, even if goods were with you, you would have valued at 8 lakhs. If you are sold at 8, don't remove unrealized loss. If really prices have gone down, don't remove unrealized loss. Okay, so record the full loss only. Okay, check. This is downstream transaction. Upstream में record your share of loss. upstream में your share. Okay, you will understand with the question, very easy. Just try to think logically. X has invested in Y joint venture. Okay, so X limited to Y limited, this is JV. Okay, you sold asset, market value 8. You sold asset at its market value 8. Okay, X limited sold an asset at its market value 8 lakh. Book mein it's 10. You sold at 2 lakh loss. But market value itself is 8. Even if it was not sold, asset is impaired, you would have recorded 2 lakh loss. Even if asset was not sold, it's impaired, you would have anyways recorded 2 lakh loss. So keep 2 lakh loss. If you sell at 8 lakh, 2 lakh ka loss, keep 2 lakh loss. But now imagine Y sold to X. Y sold to X, X purchased at 8 lakh, okay 8. Who suffered loss? Y suffered loss 2 lakh. उसमें X का share 50%, that will come to X. So I sold at 8 lakh, keep full 2 lakh का loss. Even though sir goods are with my JV, वहाँ पे आधा मैं ही हूँ, तो आधा loss unrealized. No, market value has gone down. Even if you had not sold, asset is impaired, you would have valued at 8 lakh only. तो sale पे 2 lakh loss आया. Without sale also, 2 lakh loss would have came. But if they sold to you, you bought at 8. You bought at 8. JV has a loss too. Your loss 50%, 1 lakh. So you record your share. Upstream में you record your share. Downstream में you record full. Downstream में you record full. यहाँ पे you record only its share. Very logical. I sold to JV 10 lakh rupee book value. I sold at market value 8. Market value is 8. I had a loss 2 lakh. Even if I had not sold to you, asset is impaired. Anyways, I will have a loss 2 lakh. But you sold to me. I bought at 8 lakh. Then my books asset comes at 8 lakh. Now JV suffered loss 2 lakh. My share 1 lakh loss will come to me. Okay. So first wala case is you record a full loss. Because the market value has declined. This would have come even if X would have not sold, it's impaired, the 2 lakh ka loss would have came. But if they sold, to record your share of profit, you buy an asset. Asset to bank 8 lakh. Asset to bank is 8 lakh. Asset to bank 8 lakh. Now JV sold you, JV में वहाँ पे 2 lakh का loss, half comes to you. So share in loss to investment in JV. Share in loss to investment in JV. बहुत logical. I am selling, I have a loss 2 lakh. Now goods are still lying with them, or asset is still lying with them. I say, oh, so my share of loss unrealized. No, even if you had not sold, value has really gone down, so loss would have anyways came. So keep full 2 lakh loss. They sold to you, you bought at 8, asset to bank 8. Now they have 2 lakh loss, 1 lakh comes to you. They have 2 lakh ka loss, 1 lakh loss will come to you. हो गया. Next, long-term interest in associate JV. Important. Long-term interest. In associate or JV apart from equity instrument. Okay, in associate or JV you have equity shares. Associate JV you hold equity. If you have some other long-term interest, like you also hold their preference shares, or you given some loan to them for which repayment is neither planned nor likely to occur in foreseeable future. Okay, so what are this long term? So you might hold financial instrument in associate JV other than investment accounted using equity method, that is other than the equity shares. You might hold financial instruments in associate JV other than the equity shares, and this includes long-term interest. Now long-term interest, which in substance forms a part of net investment in associate or JV, which in substance forms a part of net investment in associate or JV. Pay attention. Item for which settlement is neither planned nor likely to occur in foreseeable future is in substance extension of equity investment. Okay, item for which settlement is neither planned nor likely to occur in foreseeable future. I gave you loan. कितने टाइम के लिए? Indefinite. The settlement is neither planned nor likely to occur in foreseeable future. So they are treated as an extension of equity investment. हाँ, equity नहीं है, but it's long-term interest in associate JV. If I have a preference shares, if I have some long-term loans given to them, they are covered. So long-term loans, long-term receivables. I sold goods to them, but I gave some advisory to them. I'm never going to call for money. That's long-term receivable. Okay, so such items may include preference shares, long-term loan receivables, etc. Okay, so if I have investment in equity, associate JV mein, together with that, I have some other long-term interest. Now, pay attention. You should account for that long-term interest in accordance with 109. Yeah, you should account for that long-term interest in accordance with Ind AS 109, financial instrument. Preference shares you invested or loans you have given, it may be amortized cost. So basically you have to see 109. As per 109, financial asset can be either at amortized cost, FVT OCI, FVT PNL. Amortized cost, FVT OCI, FVT PNL. ठीक है. Now pay attention. For investment which you have done in equity shares, if that is an associate joint venture, we follow equity method. Okay, so equity shares wala investment, equity method in CFS, investment appears as investment, our share in post acquisition profit or loss we add. Okay, the investment remains as investment, our share of post profit we add, our share of post loss we deduct. Pay attention. Now we are applying equity method. Our investment in associate 10 lakhs. Now loss comes. My share of loss 8 lakh. Okay, so out of 10, 8 gone, investment 2 lakh. Again my share of loss 4 lakh. Out of 2, my share of loss 4 lakh. Investment in associate comes negative. So if investment in associate comes negative, we can't show negative, we have to show it as 0. But if you have other long-term interest, then the remaining loss you can deduct from that other long-term interest. Okay. ठीक है, let's see. Loss making associate or joint venture. Loss making associate or joint venture. Loss recognized using equity method in excess of entity's investment in ordinary share are applied to other component of equity interest in associates and joint venture, that is other long-term interest, that is other long-term interest. So I have investment in equity share, I have investment in preference share, I have some long-term loans, everything is there. If that is the case, what to do? So investment in equity share, I am following equity method. Equity method losses I deduct. Suppose investment in equity shares becomes negative, then balance you can deduct from investment in preference shares or loans which you have given, which are in effect a net investment in associate or joint venture. And sir, which order? In the order of seniority, that is priority in liquidation. Okay, priority in liquidation means liquidation may debenture holders are paid first. Debenture holders are paid first, they will bear loss at the end. The preference share will bear loss first, then debentures. Priority of liquidation, simple words, that is preference shares will bear loss first and then debentures will bear. तो फर्स्ट इक्विटी वाले लॉस बेयर करेंगे, देन प्रेफरेंस वाले, एंड लास्ट में डिबेंचर्स वाले. डिबेंचर पीपल गेट द मनी फर्स्ट, दे बेयर लीस्ट लॉस. ओके, तो इफ I have some long-term interest in associate and joint venture other than the equity shares. I have a long-term interest in associate joint venture other than the equity shares. The equity shares I'm accounting by equity method. Equity method mein my share of losses I deduct. If investment in equity comes negative, balance loss can be deducted from other long-term interest. So this is only if it comes negative. Okay, so I just tried over here. In case of loss-making associate, entity share of loss in associate joint venture may equal or exceed its investment in associate or joint venture. Okay, may equal or exceed its interest in associate and joint venture. Now, interest doesn't mean only equity, also includes other long-term interest. It may be noted that interest in associate and joint venture does not only include your equity but also includes any long-term interest which in substance are a part of net investment in associate or joint venture. Okay. Plus, entity should first apply 109 to such long-term interest. Entity should first apply 109 to such long-term interest and then apply Ind AS 28. So you should first apply 109, then apply Ind AS 28. Okay. So if investment in equity becomes zero, remaining loss can be allocated towards other long-term interest. Investment in equity becomes 0, so remaining loss can be allocated towards other long-term interest. But before allocating other loss, other long-term interest should be first valued as per 109. Other long-term interest should be first valued as per 109. Okay, sir. Other long-term interest are also 0. Other long-term interest be 0 ho gaya. Investment in equity became 0. Other long-term interest also became 0. Losses are that much. Okay, after equity interest, sorry, after entity's interest is reduced to 0, including other long-term interest. This is including other long-term interest. If all things became 0, the additional loss we should provide only if we have to compensate. Additional losses are provided only to the extent we have a legal or contractual obligation. Only to the extent we have a legal or contractual obligation, otherwise no. Okay, so now this question is very important. I was setting a paper, I'll ask this question. You have equity shares, 25% to which equity method of accounting is applied. Your preference shares. Your preference shares measured at fair value as per 109. Okay, so you have 3 types of interest in associate. Equity, preference is equity method. These are measured at fair value as per 109, and we have also given a long-term loan which we are having amortized cost. At the start, carrying amount. Carrying amount is 10 lakh, 5 lakh, 3 lakh. I have investment in equity shares, investment in preference shares, and I have a long-term loan given to associate. Okay, 10 lakh, 5 lakh, 3 lakh. Okay. Okay, for long-term interest, that is preference and long-term loan, first apply 109, then you can use them for Ind AS 28. Okay, so this is for preference share, increase decrease in fair value as per 109. Because of 109, we are doing fair value, increase decreases are given. Okay, loans may impairment loss or reversal is given, and this is share in profit loss of associate. Our share, entity share in profit loss of associate. Entity share in profit loss of associate. Okay. Entity does not have a legal or constructive obligation to bear the loss beyond its interest. Okay, if investment in equity, preference, loans, they become nil, extra loss are not to be provided. Investment in equity, preference, loans, they become nil, extra loss not to be provided. Okay. Now this is year 1. This is year 1. This was the opening balance given, 10 lakh, 5 lakh, 3 lakh. Now give effect of 109 first. Give effect of 109 first. Effect of 109 first, then Ind AS 28 ka loss. Okay, so I just write over here for other long-term interest. Effect of Ind AS 109 will be given first. And then Ind AS 28 loss is allocated. So adjustment as per Ind AS 109. Go and check preference share में क्या है adjustment first year. Oh, it goes down by 50. Loans में it goes down by 50. तो preference share goes down by 50. Loans goes down by 50. ये in preference share goes down, loans goes down. So these are the balance after applying 109. The balance after applying 109, equity share may not applicable. This is 450, 250. Okay, so this is the balance 17 lakh. Equity is 10, preference 450, and loans are 250. Now our share of loss is 16 lakh. Check karo ye raha. Our share of loss is 16 lakhs. First, equity 10 lakh ka 10 lakh goes away. Then preference will bear, and last mein debentures or loans will bear. So preference to 450 goes away. Loans mein se 150 goes. So we have balance 17. Full 16 lakh loss is absorbed. Now balance is 1 lakh. तो फर्स्ट अप्लाई 109, ये आया बैलेंस. उसके बाद इंड एस 28 का लॉस. फर्स्ट इंड एस 109, देन कम्स द लॉस एज पर इंड एस 28. Equity will bear the loss first, then preference, then the long term loans. 16 lakh loss is born, 1 lakh balance remains. When I go to second year, these are the balance, nil, nil, 1 lakh. When I go to second year, these are the balance. The year 2, opening balance, nil, nil, 1 lakh. Okay, now apply Ind AS 109 first. Yeah, Ind AS 109 first. Preference negative 50, loans may nil. Preference negative 50, loan may nil. Now preference was nil, but Ind AS 109 negative 50. Loan is nil. Negative 50, loan is nil. So now balance after 109. This is nil, this is negative 50 and 1 lakh. I can't have negative में investment in preference shares. I can't have negative investment in preference share. But okay, this is the situation. This is the situation. Now there are a few typing mistakes here. This is not 1 lakh. This is negative 50. And this is not 17 lakh. This is 50,000. Positive 50. So I have a balance only 50. This is negative 50. This is 1 lakh. Positive 50 is the balance. I have balance 50. Now what should I do? Done with Ind AS 109. Now 28 ka loss. Let's see our share of loss. Oh, 2 lakh. We have balance only 50. 2 lakh. We have a balance 50. So 50 डाल देते loss. I can't show negative. So this I make positive 50. This is 1 lakh loss 50, and now the balance becomes nil, nil, nil. So I had balance positive 50. Now I have a loss 2 lakh. I have a loss 2 lakh. I book only 50. I have a loss 2 lakh. I book only 50. 150 cannot be allocated. So there is just one more word. Unrecognized loss. There is unrecognized loss of 150 at the end of year 2. Total loss is 2 lakh. Only 50 is recognized. I can't show preference negative, इसलिए वहां पे वो 50 add कर दिया, नीचे 1 lakh deduct कर दिया. Net we are having 50 loss booked. So we had a balance after 109, 50,000, 50 loss booked. Now net everything is 0. 150 ka loss we could not book. Year 3. Year 3, everything opening is nil. Everything opening is nil, nil. Everything opening is nil. Adjustment as per 109. Okay, 109 का adjustment, preference shares going up by 1 lakh, loans going up by 50. Preference shares going up by 1 lakh, loans going up by 50. This is as per 109. Pehle 109, then Ind AS 28. So 1 lakh, this is 50. These are the balance after this. Now we have a balance 150. Now we have a balance 150. Current year loss is nil. Our share of loss current year is nil. Check karo ye raha. Our share of loss current year is nil. Next 2 year is 10 lakh profit. Next 2 years is 10 lakh profit. Our share of loss is nil. But our 150 we could not record earlier. We record now. 150 we could not record in year 2 is recorded now. Current year ka loss is nil, but previously unrecognized 150 is allocated to current year. So ye 1 lakh gaya, 50 gaya. Now again everybody becomes nil. Again everybody becomes nil. ठीक है? Everybody becomes nil. Let's move ahead. Year 4 opening is nil. As per Ind AS 109, preference goes up 50. As per 109, preference goes 50. As per 109, preference goes up 50. This is balance after 109. Now this year there's a profit 10 lakhs. This year there's a profit 10 lakh. First, debenture वालों को दो, preference share वालों को दो, then equity. Okay, the debentures have suffered a loss. How much? Debentures have suffered a loss. How much? 50,000 year 3, 1 lakh year 2, 150 year 1, 150 plus 1 plus 50, 3 lakh. Okay, so 3 lakh goes to them. Debenture. Now preference shares. First year preference share has borne a loss of 450. I just mark it. This is 450. Second year is positive 50. So 450 में से 50 गया 4 lakh and this is 1 lakh. 5 lakh total. So 5 lakh they had borne earlier. Let's give to them. And now balance 2 I give to equity. These are the balance. So whatever loss they had borne, now we are giving it back to them. Other long-term interest. Next year 10 lakh profit. Fully equity में it will be added. Next year this is as per 109. These are the balance. 10 lakh profit added in equity. Okay, the simple words. Simple words. You've done investment in associate or joint venture. You're applying equity method. Now, if you have some other long-term interest in associate or joint venture, if you have other long-term interest in associate or joint venture, and now there's a loss, the investment in equity becomes nil, then still other long-term interest may say you can deduct the loss. Investment in equity becomes nil, still other long-term interest may say you can deduct it. Other long-term interest also becomes nil. You make a provision if there's a contractual or a legal obligation to pay. If there is no contractual or legal obligation, then don't make a provision. I hope you're clear. Shall we move it? First apply 109 for other long-term interest and then go to Ind AS 28. In Ind AS 28 mein our share of loss first towards equity, then other long-term interest. Other long-term interest mein preference first, then debentures. Clear che? Done. This is basically your point of other long-term interest. Next point, this is important. Discontinuing use of equity method. Discontinuing the use of equity method. When should I stop using equity method? When should I stop using equity method? Sir, when it stops being our associate or joint venture. Correct? Now it's not our associate, not joint venture, then no equity method. Okay, so one is when it becomes our subsidiary. One, it becomes our subsidiary. So you should stop using equity method when it ceases to be associate or joint venture. Now it became a subsidiary. Subsidiary ban gaya, to kya karu? Okay, so whatever is value of investment in associate or joint venture in our CFS, that becomes our deemed consideration. That becomes our deemed consideration. Okay, no, not that becomes. Oh, already we had 30-40%, we acquire something. That's a previous interest. It's remeasured. Yeah. So retained in previous interest is remeasured. So then it will require revaluation of previous held interest. The previous interest is remeasured. The one when it becomes subsidiary, you already had 30%, now you acquire another 30. The previous 30 is remeasured, step acquisition. And number two, retained interest in former associate or joint venture is financial asset. Means you sold something, balance held is less than 20%. This is part sold and balance is less than 20%. Now it's not associate, not joint venture. Now it's not associate, not joint venture. The balance jo bacha, that will come at fair value. The balance investment will appear at fair value. Purana investment will go away. Difference, gain or loss. Okay. So fair value of interest retained and the proceeds. And we compare it with the carrying amount of investment. Difference is profit or loss. Difference is profit or loss. Let me give journal entry. Let me give journal entry for this. It will be kind of bank debit. This is for the portion sold. Investment account debit at fair value. This is the portion retained. This is the portion retained to investment in associate or joint venture. This is the carrying amount. We were following equity method. Whatever is the carrying amount, and difference is profit or loss on sale. How do I find profit or loss on sale? How do I find out profit or loss on sale? I compare bank proceeds and the investment retained with the carrying amount. This two and this three, difference is profit or loss on sale. So we compare portion retained and the proceeds received with the carrying amount. Difference, profit or loss on sale. Okay, now just one more thing. Sir, out of 40% I sold 10. Out of 40 I sold 10. Still it's associate. Pehle 40 tha associate. Still it's associate. Then in that case, 40 में से 10 sold, 30 still it's associate, then the remaining retained is not fair valued. The remaining retained is not fair valued. Remaining retained is fair valued when it ceases to be. Remaining portion retained is at fair value when it ceases to be associate or joint venture. If it still remains associate or joint venture, no revaluation, no fair valuation, some carrying amount gone, you receive something, difference is profit loss. Okay, just give a note here. Okay, let's check question 12. Question number 12. CD held 50%. 50%. Carrying amount is 1 lakh. Out of 50%, 20% sold. Out of 50%, 20% you sold for 80,000 and fair value of 30% retained is 120. Okay, now it's assumed 30% retained, but now it's not associate or joint venture. It is assumed that now it is neither associate or joint venture. So now it is not associate or joint venture. That's an assumption. Okay, so now it's not associate or joint venture. So equity method will not come. Now we received 80. And the remaining which we have, uska fair value is 120. 80 plus 120. So 2 lakh. Carrying amount goes away 1 lakh. Net 1 lakh will be profit. Net 1 lakh will be profit. Okay. I just write a note over here. If in above question we assume that %30 retained makes RS Limited associate of CD. Then equity method will continue to apply. Equity method continue to apply. Profit or loss on sale will be. How do I find profit or loss on sale? Proportionate carrying amount sold. Proportionate carrying amount sold. 50% is 1 lakh. We sold 20%. 50% is 1 lakh, 20%. This is 40,000. Selling price we sold for 80. Profit is 40. If 30% is still associate, if it still remains associate or JV, remaining interest is not fair valued. So if it still remains associate or JV, remaining interest is not fair valued. Now if it is not associate or JV, remaining interest is fair valued. So remaining is 120, sale pe mila 80, total 2 lakh, carrying amount went is 1 lakh, 1 lakh ka gain. But now remaining still it is suppose associate. So 50 में से 20% sold. 50 का value in books is 1 lakh. 50% is 1 lakh, 20% sold. So 40,000 carrying amount sold for 80. Profit is 40. So answer given is as if now it is not associate or joint venture. This is if it remains associate. If it still remains associate or joint venture, remaining interest is not fair valued. Okay, this was good question. Now going to next. Okay, now if it's not associate or JV, if it is not associate or JV, when it was associate or JV, our share of profit we have recorded, equity method. If it was associate or JV, our share of profit or loss we have recorded. If they have profit in PNL, we record in PNL. If they have profit in OCI, we record in OCI. So our share of profit in associate or JV we record. If associate JV में PNL में है, we record in PNL. They have in OCI, we record in OCI. Once now it ceases to be associate or JV, so whatever we had recorded, our share of profit in OCI, that is to be reclassified. If it is item reclassified to PNL, it goes to PNL. If it's item not reclassified to PNL, it goes to retained earnings. Okay, the reclassification of items recorded in OCI on discontinuation of equity method. Any share in OCI previously recognized shall be reclassified. Okay, I repeat again. I have done investment. We have done investment in associate or joint venture. We have done investment in associate joint venture. Our share of profit we need to add to our profits. If profits are there in PNL, we add in our PNL. If profits are there in OCI, our share we add in OCI. So share of profit coming from associate joint venture, part is there in PNL also, part is there in OCI also. Now if that associate joint venture sold, associate joint venture gone, so what we had recorded in OCI, that should also go away. If that's item reclassified to PNL, it goes to PNL. If it's item not reclassified to PNL, it will go to retained earnings directly. It will be reclassified on the same basis as if you have disposed of the related asset or liability. As if you have disposed of the related asset or liability. Okay, next. There's one enter here which is missing. यहाँ पे एक enter आएगा. That's it. Investment in associate or JV classified as held for sale. Okay, we have Ind AS 105. Non-current asset held for sale. So whenever investment in associate or JV meets the criterias of Ind AS 105, they will be valued as per 105. So once it's classified as held for sale, accounting will be as per 105. Once it's classified as held for sale, accounting will be as per 105 for that. Now imagine you hold 50%. 10% is held for sale. You hold 50%, 10% is held for sale. So for the 10%, Ind AS 105 will apply. Okay, so entity shall apply 105 to portion of investment that meets the criteria as held for sale. Portion of investment that meets the criteria of held for sale, that will be as per 105. Any retained portion, remaining portion, any retained portion that has not been classified as held for sale, any retained portion not been classified as held for sale till the time of disposal, account using equity method. So till the time of disposal, account it as equity method. This is for the portion retained not classified as held for sale. After disposal of the portion, okay, till the time of disposal of that held for sale wala account using equity method, and afterwards also, if the retained interest continues to be associate joint venture, okay, so retained interest continues to be 40 50 में से 10 gone 40 still associate ना, continue equity method. Agar no, then you go for 109. Okay, so pay attention. 50%, out of 50%, 10% held for sale. Okay, so just pay attention. I just write over here 50 में से 10% held for sale, and this is to be retained. This is to be retained. So this will be as per Ind AS 105, and 40% I want to retain, right? 40% I want to retain. Even after selling 10, 40 may will be associate, continue equity method. Continue equity method. But imagine 30%. Okay, just pay attention. Imagine I just write like this for your understanding. Say 30, 15, 15. 15 held for sale, and this is to be retained. Held for sale goes in Ind AS 105. This to be retained. तो इसका क्या करें? Till the other 15%. Okay, let me make it 12 and 18. Till the 12% is sold, equity method. Till that 12% is sold, equity method. After 12% is sold, Ind AS 109, as now it is not associate or JV. Okay, so this is exact wordings. 12% held for sale, apply 105. 12% held for sale, apply Ind AS 105. 18% remaining. Till that 12% is sold, till you are not sold that 12%, it's just held for sale, equity method. After that 12% is sold, then remaining is 18. After that 12% is sold, remaining is only 18. Now it's not associate or JV, account as per 109. But after selling, still if it is associate, then continue equity method. This is the best example what I can give. So 12% which is held for sale, accounted as per 105. Remaining 18 which is to be retained till you sell 12%, equity method. Once 12% is sold, now it's 18. It's not associate JV, account as per 109. This is what is written. Okay, I just go over here, check the theory again. Okay, for the portion that meets the criteria, apply 105. Retain portion, remaining 18%. Till you sell the 12%, use equity method. Till you sell the 12%, use equity method. Once 12% is sold, now 18 remains. If it is still associate or JV, apply equity method, otherwise go for 109. If it is still associate or JV, apply equity method or go for 109. So for the portion classified, apply 105. Retained portion, till you sell that 12%, equity method. Once that 12% is sold, now remaining still abhi wo associate hai, to apply equity method. No, then go for 109. I hope this is clear. Okay, this is a question on it. You hold 50%, balance 50 is with someone else. You're planning to sell 10%. You're planning to sell 10. The 10% will be, okay, till the time 10% is sold, 40% is accounted as per equity method. Till the time, और 10 जब तक सेल होता है, 40 is as per equity method. After 10 is sold, 40 is still associate. After 10% is sold, if Ram still has joint control or significant influence, it shall continue using equity method. If it still has joint control, I just add the word or significant influence. So if you still have joint control or significant influence, continue the equity method. Continue equity method. Okay, next. This is reorganization of group structure, accounting in separate financial statement. Reorganization of group structure, accounting in separate financial statement, not CFS. Not CFS. Not CFS. This is something they give guidance on how to calculate. They are giving guidance on how to calculate cost of investment when parent reorganizes the structure of group by establishing new entity as parent. Okay, parent brings a new entity in between. It was A to B. Now they make it A, double A and B. It was A to B. Now they make it A, double A and B. So if parent introduces new entity, double A should not be existing. New entity. So it was simple, like ये A to B था. A limited to B. Now A forms double A. A forms double A. So A to double A to B. So effectively it's one and the same. Here double A is controlled by A only. double A is fully controlled by A only, so still it's kind of A controls B. So if this thing happens, how to calculate the cost of investment? So A to B, now it's A to double A. A to double A. So they have given the new parent double A. New parent is actually double A. Obtains control of, okay, new parent obtains control of the original parent. They are trying to say, just wait. New parent, just don't write A double A, I just have to see the example what they have given. The new parent obtains control of original parent by issuing equity instrument in exchange for existing equity instrument of original parent. Assets and liabilities of new group, original group are same. The assets, liabilities of new group, original group are same. And owners of original parent before the reorganization have the same relative interest in the original group and the new group. The owners of original parent, whoever was owning A Limited, they have the same interest in original group and the new group before and after reorganization. Okay, let me just check their example. Okay, existing structure, owners to A, and then A is having 100% in B and C. The owners to A to B, C. Now, owners to new company. Okay, so it's like ऐसा है. I just write A Limited to B Limited. Now they have double A Limited to A Limited to B Limited. But double A Limited is new company formed by same owners. It's a new company formed by owners of A Limited only. The owners of A Limited only have formed double A. So earlier it was owners to A to B. It was owners to A to B. Now owners to double A to A to B. It's kind of this. Okay, if at all this way it is done. Owners are still the same. Unka interest previously and now, original group, new group mein it's kind of same only. Then pay attention. If above conditions are fulfilled, new parent is double A, elects to account investment in original parent at cost, then the new parent के लिए cost will be the carrying amount of its share of equity shown in separate financial statement of original parent. In simple words, double A का investment in A, double A's investment in A will be equal to equity in A. Whatever is equity in A, that will be the value. The new parent elects to account, new parent is double A, investment in original parent A. Originally parent was A, new parent is double A. Okay, so if new parent elects to account for investment in original parent at cost, new parent shall measure the cost. So what will be the cost? So this will be what? Carrying amount of equity items shown in separate financials of original parent. So what is equity in A? That will be the cost of investment for double A. So A में जितना equity है, same amount double A will put it as investment in A Limited. Okay, check over here. So whatever is equity in A, same amount will be put as investment in A Limited by AA Limited. So for AA Limited, investment in A value will be equity of A. Let's see. The cost of investment in A to the owners is 10 lakh. वो नहीं देखना है. Cost of investment to owner is 10 lakh. Equity of A in separate financial statement is 15. Okay, equity of A in separate financial statement is 15. AA Limited will record investment in A at 15 lakhs. AA will measure investment in A at 15 lakhs. New company, I just say it as AA. Okay, so owners have added a new company in between. It was owners to A to B and C. Now owners to AA to A, and A to B and C. So now AA will have shares of A. Cost of investment in A, take it as equal to. Cost of investment in A, take it as equal to equity of A. This is if relative rights of owner earlier and now are same. तो ये 100% है तो ही. If new company is 100% by same owner, then only. If new company is 100% by same owner, then only. Just one concept added, and this is only for separate financial statements. Okay, this is done. Let's go to next question number 15. Two more questions. Let's do it. Okay, X was holding 100% equity capital of Y, and Y was treated as a subsidiary. Okay, you hold 100% equity share capital of Y, you were treating it as subsidiary. Now Y issues convertible preference share. As per the issue document, they get a right to participate in relevant activities. And the consent is also necessary to pass decision. Oh, so earlier I used to hold 100%, I can take any decision. Now I need their consent as well. They issued convertible preference share, I need their consent. So I don't control unilaterally. Earlier I controlled alone. Now I need their consent. We both control together. Joint control. Okay, so how to account for investment? Determine how to account for his investment in Y after the issue of preference shares by Y. Earlier it was like this. Now Y is jointly controlled by X and Z. As per the issue document, you need the unanimous consent of X and Z both. It's a jointly controlled. Okay, and it's a separate vehicle, so it's a joint venture. Now earlier it was subsidiary. Earlier subsidiary you are consolidating, now it becomes joint venture. तो क्या करे? तो assets, liabilities, goodwill, NCI, remove it, and investment in joint venture comes in. So you lose control. The X Limited loses control. What to do? De-recognize the asset liability from its consolidated financials, and investment will be accounted at fair value on the date of loss of control. Any goodwill etc. recorded will also go away. And the difference is recognized in P&L. Okay, so earlier subsidiary, now it becomes a JV. Earlier subsidiary, now JV. Earlier subsidiary, now JV. As it was subsidiary, we had their assets, liabilities, that all will be removed. Investment in JV will come up at today's fair value. Difference goes in P&L. Done? We have done this type of question. Yes, we have done this type of question earlier as well. Next, 16th question. M Limited holds 90% in N. Okay, that is M Limited to N Limited. This is 90%. And N holds 25% in O. Okay, so O is associate of N. Subsidiary ka associate is also our associate. Subsidiary's associate is also our associate. Subsidiary's associate is also our associate. Now, they have a net asset 300 lakhs, including this year's profit of 40 lakh. Now, subsidiary's associate is also our associate. 25% is held. So, in our balance sheet, investment will appear. They have a net asset 300 lakh. 300 lakh ka 25%. They have a net asset 300 lakh. 300 lakh ka 25%. So investment in O Limited will appear in CFS. Investment in O Limited will appear in CFS 75. Now the share of profit 40 lakhs. Investment appears 75. Now share of profit 40 lakh coming from them. Share of profit 40 lakh, not total share, total profit is 40 lakh. 40 lakh ka 25%, 10 lakh. 40 lakhs 25% is 10 lakh. 10 lakh profit. Okay, so 25%, 10 lakh profit comes to N. 10 lakh profit comes to N. N may we hold 90%, 10% is others. So see, they earn 40 lakh profit. 40 lakh ka 25% goes to N. So N will get 10 lakh. 10 may say we will get 90%. So we get 9 lakh, NCI gets 1 lakh. So we get 9 lakh, NCI will get 1 lakh. Okay, the question was how to account for this. So N is a subsidiary of M. And consolidated financial statement of N. A consolidated financial statement of M will include 100% amounts of N. Even though we hold 90%, we add 100% asset liability. 10% belonging to others appear as NCI. 10% belonging to others appear as NCI. So even though we hold 90%, even though we hold 90%, comma 100% assets and liabilities of subsidiaries is included in CFS. For 10% held by others, NCI will come. Okay, तो उनके 100% asset, उनका 100% asset will come in our book. They have investment in O. Therefore, investment in O, whatever is done by N, fully will appear in our books. Therefore, investment in O Limited done by N Limited will fully come in our CFS. उसका फिर 10% NCI में जाएगा, but it will fully come in our CFS. So in CFS, investment in O will be 300 ka 25%, not 25 ka 90, not 25 का 90, 300 का 25%. Opposite 10% NCI में it will come. So it will come 75. $7.5 will come as NCI on opposite side. So their full asset comes. So their full asset is 300 into 75%, 25%, तो 75 comes. Full asset comes. उसमें से 10% opposite NCI. Now share of profit 40. Share of profit is 40. 40 that is there. उसमें से 25% is the share. So that is coming as 10. हमारे में it will be. In our PNL we will have 9, 1 will have in NCI. In our PNL we will have 9 and 1 will go to NCI. I hope you are clear. So we add 100% asset, we are adding 100%. Opposite 10% will appear under NCI. Oh yeah, done. Next question. 17. You hold 30%. You hold 30% in an associate. Cost is 300 lakh. On that day, उनके net asset was 900. 900 का 30% is 270. Goodwill came 30. Okay. Under equity method, goodwill is just for disclosure. याद करो, equity method में goodwill doesn't appear as goodwill. It's just for disclosure in brackets. ठीक है. After the acquisition, AB accounted as per equity method. So you accounted as per equity method. And now the carrying value of investment is 360 lakhs. Associate issued new shares. Associate issued new shares to other investors for 800 lakh. And now your holding became 20%. Okay, you were holding 30%. Now they issued new shares to others. They issued new shares to others. Your holding became 20%. Your holding became 20%. How should you account for this? Your holding became 20%. So indirectly you sold 10%. आपका 30 था, अब 20 हो गया. 10% you sold. Carrying amount of 10%. Carrying amount of 10%. So it's indirectly. AB Limited is effectively sold 10%. Now how do I get carrying amount of 10%? 30% is 360. 10% is how much? Okay, so carrying amount is this. And you will receive. They issued 800. अब आपका share is 20%. Now your share is 20%. 800 में से 20% you will receive. As now your share is 20%. Out of 800, 20% comes to you. Out of 800, 20% is coming to you. 160 you are getting. Carrying amount 120 gone. Reduction in interest is 40. And note, even after reduction, it still remains associate. You still have 20%. It still remains associate. So earlier you had 30%, now it's 20%. Effectively 10% sold. 10% का carrying amount 120. Effectively you are getting 160. So 10% carrying amount is 120. Effectively you are getting 160. You're not getting cash. You're not getting cash. तो क्या करेंगे, entry will be, you're not getting cash, so we will add it in investment in associates debit 40 to PNL 40, and I just write we are not getting cash. So can't write cash, it's investment debit 40 to PNL 40. So effectively 10% gone. Unke net asset increased by 800, your share is 160. So unke net asset, they got 800 crores. So I am my share. So indirectly my share, net asset goes up 160. My carrying amount is 120. So carrying amount 120, my share of net asset goes up by 160, profit 40. We are not getting cash, don't write cash. And don't write bank debit 160, we are not getting bank. Associate raised 800, unka net asset went up by 800. Net asset went up, cash they got 800, liabilities nahi, capital bada, not liabilities. So the net asset increased by 800, my share 160. So my share of net asset increases 160, mera carrying amount goes away 120, net 40 benefit. Okay, this is done. 18th question important. 18th question important. Last question. 18th question is important for your exam. Okay, you hold 90%. You hold 90%. You sell 70 for 56 crores. And now you lose control. You lose control. And fair value of 20% retained is 16. Fair value of 20% retained is 16. And net asset carried is 60. Okay, it's subsidiary sold. Subsidiary sold. Net asset goes away. Net asset goes away, NCI goes away, we are getting something, remaining investment is also there. I just make the journal entry. Actually it's given, chalo, I just go down. Actually it's given. So net asset 60 goes. Net asset 60 goes. NCI, I assume it's at proportionate net asset. 10% is NCI 6. The NCI 6 goes. Okay, I just go down. This is a loss of control. De-recognize the asset liability. Recognize investment retained at fair value. Recognize investment retained at fair value, and then you calculate gain loss. Okay, so net asset goes away, here 60. Net asset goes away 60, credit. Assuming NCI is at proportionate net asset, NCI has a credit balance. Assumed at proportionate net asset, 60 ka 10%, 6 NCI, liability goes debited. Liability goes debited. We are getting 56, bank debit, 56. And 20% retained comes at fair value 16. So 20% retained, that fair value comes in. Balance is profit or loss. Net asset 60 goes away. NCI 6 goes away. We are getting 56. And we are also having investment coming at fair value. Balance is profit or loss. Done? Now, subsidiary sold. Subsidiary sold. So now, when it was a subsidiary, unke profits were recorded. उनके profits were recorded. Okay, their profits in P&L were included in P&L. Their profits in OCI were included in OCI. Now when subsidiary sold, their OCI items are to be removed. If it is item reclassified to P&L, take it in P&L. If it's item not reclassified to P&L, directly take it in OCI. Okay, now this net asset include following. This net asset include following: debt investment classified as FVT OCI, related FVT OCI reserve is 6 crore. Okay, related FVT OCI reserve is 6 crore. Now, वो 6 crore उनका OCI reserve था, उसका 10% NCI में है. 10% will be with NCI, वो opposite हमने NCI में बताया. तो 5.4 was our share. 5.4 was our share. Debt instrument classified as FVT OCI, it's a item reclassified to P&L. Okay, debt instruments through OCI, it's an item reclassified to P&L. Okay, so out of 6, 10% वो NCI का था. 5.4 that FVT OCI reserve will now go to P&L. 5.4 goes to P&L. Check the solution. See, reclassify the FVT reserve in respect of debt of 5.4 attributable to owners to P&L. It's item reclassified to P&L. It goes to P&L. Journal entry. FVT OCI reserve on debt instrument to P&L. FVT OCI reserve on debt instrument to P&L. Okay, next one. Net defined benefit liability 6 crore. Uska related reserve is -3. Okay, -3. Uska related reserve, and it's an item not reclassified to P&L. Sir, which are the items reclassified to P&L, not reclassified to P&L? Bhaiya, you've done in schedule 3. You've done in schedule 3 OCI में some items reclassified, some items not reclassified. Debt instrument is reclassified to P&L. Remeasurement of net defined benefit liability is not reclassified. Equity instruments through OCI is item reclassified. Item not reclassified. Debt instrument was reclassified. Equity is not reclassified. Okay, these are not reclassified to P&L. They go in retained earnings. But what is the reserve balance? Reserve balance is 4. Usme bhi 10% is NCI. Ye 3 is nothing but 2.7 and 4 is nothing but 3.6. Ye 2.7 ka loss. Okay, loss. Retained earnings debit. Retained earnings debit to reserve relating to net defined benefit liability. See retained earnings. यहाँ पे retained earnings है, यहाँ पे P&L है. Okay, 2.7. Same way for FVT OCI related to equity, they go to retained earnings. This also will go to retained earning. And last one, foreign currency translation reserve. Foreign currency translation reserve. This is item reclassified to P&L. Item reclassified to P&L. Okay, the foreign currency uska 8 का 10% is with NCI 7.2. 7.2 ये reserve को debit करो, P&L credit. So 7.2 reserve will be debited, P&L will be credited. Iska 10% is not lying here, it has gone in OCI. Done. This is all for the day. हो गया chapter of consolidated financial statement. Okay, so we had seen all updates which have came up in ICAI new material. 2 lectures we took. One yesterday covering other than CFS, and this one covering CFS. Sir, what about Ind AS wale thing? Ind AS is latest recorded, and Ind AS ke andar the COVID questions were already added, which they've added now. The ICAI has added mostly COVID related question, which we have already added in our material earlier. So as such, no major changes in Ind AS portion. Still, if any questions I feel are good, I'll come out with a supplementary sheet. You can refer it on your own. Now for exam purpose, what to do? Our lectures, our material, what we have done, this second supplementary material, and number 3, last 3 RTPs. I'm telling you again, our material, this supplementary material, and last 3 RTPs, they are must. I'm telling you, this is must. If you don't do anything else, it's fine, but these are the minimum 3 things which are to be done. Last 3 RTPs. Don't do only your attempt, last 3 RTPs has to be done. And always remember, your efforts will give you success if you put it. If I'm not doing the things, it will never work. And see, if you want to climb a mountain, or if you want to lift a mountain, you need to start lifting the stones today. Yeah, so tomorrow I want to lift a mountain. Today I need to start by lifting the stones. Slowly and gradually you do the things, you will get the courage and you will crack your examination. But ups and downs will come. There will be times where you feel, sir, I'm very frustrated, I'm fed up of studying, and there will be time where you'll be happy also. Keep short-term targets. I'm telling you, short-term targets. I want to finish up this subject in 10 days. And 10 days maybe, I'll do this much, this much, this much, this much, this much every day. Keep daily targets. And I tell you, this is the life, or this is currently the phase where you can have daily targets. And if you fulfill your daily targets, you will be the most happiest person. Next day, you wake up with a smile on your face. And very, very important, 15, 20, 30 minutes a day, you give yourself for health as well. Your physical health, 20 to 30 minutes a day, you need to give for it. Some yoga, some dance, some sports, or basically going for a walk, that is required. You know, current scenario, things are not good. We need to ensure our immunity is at the top. Yeah, we have a good amount of immunity. We are doing whatever is possible for our health. Bit of physical exercise, healthy diet, timely studying. Every 3 hours you study, take 1 hour break. Again 3 hours you study, take 1 hour break. But make sure that 1 hour is 1 hour. Don't make it 61 minutes also. Be disciplined. Success will be yours. Success is nothing but small disciplines which are practiced every day. Okay, see you all. Bye-bye. All the best. Take care.